If you hold a credit card at any institution, you might have a general idea of how your credit score works. Use it and pay off most of it monthly. Do this consistently and your credit score goes up, which gives you access to better benefits, higher loans, and more. But do you know that companies also have this kind of credit rating? Much like individual credit scores, companies and government entities have credit ratings, which are independent assessments of their credit worthiness. These ratings are crucial as they influence the interest rates entities might pay and their ability to raise capital. They are assigned by renowned credit rating agencies like S&P Global, Moody's, and Fitch Ratings. These ratings are expressed as letter grades, ranging from AAA, indicating excellent credit worthiness, to C or D, signaling poor credit standing. A high credit rating suggests that the entity is likely to meet its financial commitments, while a lower one implies a higher risk of default. Investors and lenders heavily rely on these ratings to make informed decisions about whether to engage in businesses with the rating entities and to determine the interest they would expect to receive to compensate for the risk involved. For instance, bonds issued by an entity with high credit rating are likely to pay less interest than those issued by one with a lower rating. But why are these so important now? Credit ratings have been a pivotal part of the financial landscape since the early 20th century. They gained prominence post-1936 when new federal banking regulations were introduced, prohibiting banks from investing in speculative, low-rated bonds. This practice was adopted to mitigate the risk of default, which could lead to substantial financial losses and even bank failures. However, if you've taken a look at the 2008 financial crisis, you might have seen that inflated credit ratings brought everyone's expectations of a company's safety way up. It is for this reason that credit ratings are so very vigorous and companies undergo lengthy evaluations. In fact, there are only 2 companies in existence with the best rating of AAA, Microsoft as well as Johnson & Johnson. Credit ratings are not just vital for investors, but also for the entities being rated. A high rating can facilitate access to necessary capital at affordable interest rates. Conversely, a low rating can lead to higher interest rates or even hinder the ability to access capital. Entities usually request ratings for themselves or the securities they issue and pay their rating agencies for their services. These ratings are not static and can change based on the entity's financial health, market conditions, or other relevant factors. In essence, credit ratings serve as the corporate counterparts to personal credit scores, offering invaluable insights into the financial stability and creditworthiness of entities. They are the informed judgments made by rating agencies, providing a snapshot of the potential risk involved. While they are not absolute guarantees, they are instrumental in aiding prospective investors and lenders in making educated decisions, ensuring a balanced and informed financial ecosystem. Remember, just as you would monitor your credit score and take steps to improve it, companies and government entities are also mindful of their credit ratings and work towards maintaining or enhancing them to ensure their sustained growth and stability in the financial market.